Steve Hanke is back. He is a professor of applied economics at Johns Hopkins University, and he has correctly called for inflation to tick up to 6 to 9% this year. We've actually exceeded the top end of his forecast. The latest CPI reading came in at 9.1% last week, headline inflation. And the question is, obviously, for Professor Hanke, will this get any hotter, or is this the peak? Professor Hanke, welcome back to the show.
Good to be with you, David. Well,
all right.
The first thing I'd note is that I did that work with John Greenwood, as you know, and we published that in the Wall Street Journal on July 20th, 2021, about a year ago. So we made the forecast about a year ago. We were the only ones who ever actually put a number on anything. And let's face it, we did hit the bullseye. No one's perfect. We said it might get up to 9%. It's 9.1. That's pretty close. Now, the interesting thing about that is that since we were the first and only ones to ever accurately predict what has actually happened, I think only one major publication, Fortune magazine, has run a couple of articles on this, but no other major publication has picked up on it at all. Now, of course, you've picked up on it with Kitco, but that's it. So it's a fascinating story.
Well, you published it on the Wall Street Journal.
How in the world you can get a very accurate forecast of the greatest inflation we've had in 41 years, and no one reports on it. And Greenwood and I have written a whole series of articles in the Wall Street Journal on this. So it's not a deep, dark secret of some obscure publication by some academics and whatnot. It's in the big journal. Okay. Everyone knows about it, and no one reports about it. No one asks a simple question. Well, how did you do it? Do you have a crystal ball, or do you have a model? No, we have a model, a quantity theory of money, MV equals PY. That's how we get there. It's a model that's been around since the 16th century, and it worked like a charm. Now, the question you asked is this the peak? And I would say, yes, probably pretty close to the peak or the peak. We said 9%, it's 9.1. So that would suggest that a year ago we thought 9 was going to be about the peak. So and now, where are we going from here? We're going to be using again the same model John Greenwood and I used. John and I have done more work on this. It looks like we're going to be 6 to 7% for the rest of this year and the rest of next year going into 2024. 6 to 7%. And the reason for that is that there's a lot of excess money that still hasn't come out into the economy. It's been produced. Remember, since February of 2020, we've had a 41% increase in the money supply measured by M2. Yeah. And of that, you've only had about 12.5%, 13% eaten up. So the rest is coming out. Around 28% will eventually come out into the economy as what? As inflation. And that's where we end up with our 6 to 7%. So there you have it, David. That's where we're going. The markets, by the way, are not pricing this in at all. I think the markets are way, way off. If you look what the markets are pricing in, they're pricing in about 3.2% inflation on average for the next 2 years. So it's going to be about double that. It's going to be about double that.
Okay, I want to come back to the quantity theory of money, and I want to drill a little bit deeper into your forecast. I'm curious as to why you haven't updated your model. We'll come back to that in a few minutes. But first, I want to play a little game with you, Steve. You know that game, The Price is Right? Ever watch that show on TV? The Price is Right?
Oh, yeah. I'm a big-time winner on that thing. Go ahead.
All right. We're gonna do the reverse, okay? So I'm going to give you an item, and I'm going to quote you the actual price of that item as of today's dollars, and I want you to guess what that item cost 40 years ago in the 70s, okay? You ready? So Big Mac first. So the average price of a Big Mac in the U.S., $5.80 as of January 2020. So $5.80. What was it back in the 70s, mid-70s?
Well, did they make Big Macs then, or just Macs?
Oh yeah, Big Macs. It was I had this picture of a vintage menu from McDonald's. I'm going to show the audience.
By the way, the first, let's go way back into history now. One of the first McDonald's that was ever established was in Omaha, Nebraska.
Yeah.
That was about 50 miles from where I grew up in Iowa.
Oh wow.
I can remember going over there and we'd buy Macs for 15 cents. And this was in about circa 1959, 58, 57, something like that.
Okay.
Yeah, 15 seconds. But that's a regular. They weren't making Big Macs then.
Okay. Well, at some point, I don't know the history of McDonald's as well as you, but at some point they started making Big Macs. I mean, they also had quarter pounders and other things, cheeseburgers and things you still see today. But they had a Big Mac on the menu back in the 70s. So it was.
Let me guess. I think it was about $1.25.
$1.25. You're off by a little bit. It was 65 cents.
You're kidding.
Yeah, it was 65 cents in the 70s. It's $5.80 now. All right, let's move on to the next one. So Volkswagen Beetle, they've discontinued.
By the way, did that include? I was giving you a price that included French fries.
Oh no, that's just the burger. It's not the meal.
So I'll adjust. I agree. It was 65 cents. If you had it with French fries, it was about $1.
Probably. Well, it comes with French fries and a drink. So no, we're not talking about the trio here. We're just a burger. Okay, so. The next one, Volkswagen Beetle, they've discontinued making these, but as of 2 years ago, they were still on sale. 2019 model goes for an average of around $24,000 to $30,000 in the U.S. Let's say $25,000 for a Volkswagen Beetle, a relatively new model. What was that back in 1972?
I'd say about $2,300.
You're spot on. $2,000.
Well, I know because I bought one then.
Okay. When did you buy it?
1969.
Oh, okay. Wow, that's pretty close. Yeah. All right. So you probably bought the higher end version then. It was $2,300.
Let me ask you a question.
Yeah.
So every Saturday, a good friend of mine, actually Dr. Dwayne Acker, who was a president of Kansas State University for 10 years, would deliver to my mother. Of course, he was a teenager at the time. I was a much younger kid. This is circa 1955.
Yeah.
He would deliver a freshly dressed chicken to my mother every Saturday, and I was allowed to give him the money for that freshly dressed chicken. How much money did I give Dwayne?
It was just a chicken, didn't come with anything?
Freshly dressed, fully dressed, high quality chicken. 1955, let's say, roughly.
1955. Oh boy, a whole chicken today. I go to the grocery store. It's half a chicken is like $7. A whole chicken is probably $15 where I live. 1955. Right. Let's see. I want to say divided by 10. I want to say $1.50.
65 cents.
Okay. Wow.
65 cents, and that was delivered to our front door. We didn't even have to go to the store to buy the thing.
Yeah, so that came with a delivery cost. Nowadays, if you add the Amazon delivery fee, it's going to be even more.
Yeah. Furthermore, it was fresh out of the hen house. I mean, I think probably Dwayne slaughtered that thing Saturday morning before he brought it over to our place.
I think the point I'm trying to make here, Professor, over the decades, prices have gone up a lot, which is which is essentially what inflation is. Prices have inflated relative to the purchasing power of the dollar. My question to you now is, Professor, since 1955, do you think that the average American living standards have caught up with the inflation, with price inflation?
Well, yeah, the adjusted for inflation, incomes have gone up, so living standards have gone up. And when you think about it, there are all kinds of things we didn't even have in 1955. I mean, in 1955, we just bought our first television. That was a big deal where I came from, out in the country. You know, no one had a TV. We got about the first one in the area. All the neighbors were coming over there to watch the thing because they'd never seen a TV before. Just think about that.
Well, yes, technological innovations have made things like TVs cheaper over the years, but you know, I'm just talking about basic living standards, basic cost of living, rent, food, clothing, healthcare. Could the average American afford the same amount that today as they did back in the 70s, let's say?
Yes.
They could. Okay. Are you concerned at all that?
Things are even as bad as things happen to look today. If you really reflect on things seriously, things are getting better, not worse.
Okay.
From a living standard point of view.
People are concerned that their wages won't be able to catch up with inflation now. I mean, you're projecting 6 to 7% inflation next year. Do you think wages can continue to grow at the pace of inflation or beat inflation for the next couple of years?
Well, what's happening, you see now the first thing we talked about is kind of the broad picture of living standards over a long time, you know, and definitely they're unambiguously getting better. The short-term thing now you're talking about is what's happening to the wage versus inflation battle right now. And wages have not been keeping up with inflation. Mm-hmm. People didn't anticipate the inflation that we have. Almost no one predicted it except John Greenwood and myself. So as a result, they didn't demand higher wages to accommodate that increased inflation that's actually occurred. They will step up to the plate in the next rounds of wage negotiations and demand higher wages to try to keep up. That's the way it always works. They're not going to stay in the hole, you know, forever watching their inflation-adjusted wages and income go down over time. They're going to demand adjustments upwards.
So here's what we've got. We've got a looming recession. If you believe that the Atlanta Fed GDP Now tracker is accurate, they're predicting a contraction in Q2. That would make 2 consecutive quarters of GDP growth, which would mean we're in a recession now. If we're in a recession, Professor Hanke, not governments, but companies will be squeezed in their margins. They're not going to be able to afford people to pay people as much as maybe they used to, or maybe they'll still, you know, increase your wages by a little bit, but not at the pace of growth that we were accustomed to in the past 2 years. So my question is, you've got inflation on one side pushing up wages, you've got a potential recession weighing down on wage growth. Which force do you think is going to win out?
Well, first of all, the Atlanta Fed is one thing. The thing I'm going by is Greenwood and Hanke. We think there's a 70% probability we'll be in a recession by the end of the year or early next year, using the quantity theory of money, using MV, money times velocity equals PY, the price level times Y, the real rate of economic growth or activity. So we will be in a stagflationary situation. And I would not bet on the scenario you gave where companies are going to be squeezed and they're not going to be accommodating wage increases, because right now their balance sheets are pretty strong. Companies are in pretty good shape. And I think there'll be some upward adjustment in wages. So the next round of wage increases will be upward.
Okay. Let's move on to the next segment of our conversation. Now, I want to talk about how governments around the world are using various policies to combat inflation, either bring inflation down or to, in their views, I guess, help alleviate some of the pain that inflation is causing to the average person. Let's start with things closer to home. So the inflation relief checks that Californians are expected to get, this came out not too long ago, the news, a couple of weeks ago. I'm just going to read the first paragraph of this article here from CBS. About 23 million California residents will receive inflation relief checks of up to $1,050 after Governor Gavin Newsom on Thursday signed a $308 billion state budget that includes the payments. Inflation relief checks. Is that going to help?
Well, for those who receive the checks, it'll be a windfall that they'll put in their pocket, but it's a gimmick. It doesn't have anything to do with controlling inflation. Inflation is always and everywhere caused by one thing: too much excess money being created by a central bank. So the relief checks it's literally a political populist gimmick. Okay. And by the way, people won't change their consumption patterns because they won't view these windfalls as being increases in their permanent income. Whatever people view as their permanent income, where they think it's stabilized and permanently going to be, that's how they gear their economic activity. And if they get a one-time windfall, they'll just put it in their pocket. They won't spend it. So as I say, for them, it's a windfall, but you got to ask the question: where's the money coming from? It's coming out of somebody. It's coming out of somebody else's pocket. Maybe it's coming out of their own pocket.
Well,
it's like a temporary tax cut. Temporary tax cuts are usually just gimmicks. They don't really affect anything over the long term because they don't affect permanent income that people have. They're just temporary windfalls.
Supposedly, the state has a $97 billion budget surplus, and so they're taking this. They're taking, like you said, it's basically designed as a tax refund, and it's supposed to be coming out of the state's budget surplus.
Point number one, they tax people too much in the first place. That's why they have the big surplus. Right. So they should be refunding most of the money. And instead of saying, "Oh, we're great people, we're giving you some inflation relief money," they should say, "We made a huge mistake. We overtaxed you tremendously. The state's running a huge budget surplus, and we're giving you a refund."
Well, it is a politically more sound, or I guess favorable thing to say, that they're helping people with inflation. Now, is this actually going to make inflation worse, do you think, where will it have no effect on inflation? I mean, essentially, aren't you increasing the money supply, or no?
No, you're not increasing the money supply.
Okay.
So the money supply is not going to be affected, and inflation will be affected. As I say, gimmick with a capital G. It's a populist thing, the kind of thing politicians can get away with. But
all right. I'd like you to react to some of the things that the Europeans are doing. So in Spain, for example, they're considering weighing a 5% levy on banks and charging an extra tax on any corporations with a turnover of greater than €1 billion. And they're going to use some of this money to, I guess, make public services cheaper. For example, they're going to make trains free. And they're going to basically do what they can to help alleviate some of the troubles that Spaniards are facing when it comes to inflation. Supposedly, these levies will bring in $7 billion, or euros rather, 7 billion euros of additional revenue to the state. In Germany, they're doing something similar. They are actually making they've already proposed a €9 a month train pass to all Germans, which is so basically they're making transportation a lot more accessible and affordable. So European countries are trying to make public services a little bit cheaper. Supposedly this will help, but again, the question is, where is this money coming from? Is this actually going to help with people coping with inflation, and B, will it have any significant impacts on inflation itself?
Well, it's not going to have any impact on inflation. That's number one. That's the European Central Bank, and Frankfurt determines that, not what's going on in these individual countries. Now, Spain that's just a greed tax. That's a socialist government, of course, in Spain, and that's what I call a greed tax. Again, very, very populist thing, and as well as Germany, there's no such thing as a free lunch. They're giving these people this money, saying, you know, you're going to get a free lunch, but somebody's paying. There is no such thing as a free lunch.
Well, how's this going to come back to them?
It's all smoke and mirrors. The European politicians, of course, California, we know that's become kind of la-la land. But right. If you go to Europe, you have incompetency in all these governments from A to Z. And the incompetency is really highlighted in one big thing, and that's the sanctions the EU is imposing on Russia, especially in the oil and energy sectors. It's literally destroying Europe's economies, particularly Germany. Deutsche Bank just came out with a report a couple of weeks ago saying that a lot of people were going to be burning wood this winter in Germany. Can you imagine? Going back to the Stone Age, talk about living standards. We were talking about living standards, and now they're going to be burning wood in Germany. I mean, these people are really on a different planet. They've imposed the self-imposed destruction on the German economy is being proposed and implemented by the current government, which is a coalition government of social democrats, meaning socialists, and the greenies, which of course the greenies are way out there. This is unbelievable what's going on. People don't realize Germany is being asphyxiated by who? Germans.
Going back to economic theory now, Professor, in theory, why can't we have free stuff? I mean, this is an extreme example. Why can't we have free public transportation, free schooling, free healthcare? How's that going to come back to us?
Well, you can have free things, but once something is free, number one, it gets overused. And if it's free, what happens? It gets overused, and then the politicians say, oh, we don't have enough train capacity. We've got to build new trains, or whatever it happens to be that's free. So you overuse it. It forces you to overinvest in it. And when I say overinvest, that's wasting a lot of resources. And where do you get the money to invest in more capacity? You've got to go to the taxpayers to get it. Somebody has to pay. Nothing is free.
Well, it's probably
if you're using public transportation, even if the existing capacity is there and you're not expanding it, you have to pay people to run the trains. You have to pay for fuel to go into the trains, et cetera, and maintaining the trains. And all those things eat up resources. And what a price of zero implies that the cost is zero, but we know the cost is not zero. The only way in a rational system to sustain yourself is to charge a price that covers the cost of something. If that's not the case, eventually what happens? Eventually in a private enterprise system, the company goes bankrupt.
Right. I'm not.
Can you just think about it this way? What if General Motors started giving away cars? How long would they be in business?
Well, that's not a public good, right? That's not. I mean, we don't need cars.
Public. Oh, it's public. You. If you think the way these people think, these nuts that are making policy, you think it. Cars they're a human right. You have to have a car to go to work. You have to have a car to go to school. You have to have a car to go to the grocery store. You must have a car. And they argue that things like cars are not only a public good, David, they're a human right, and they should be enshrined in the Constitution.
Well, to answer your question, I would theorize that you would still have cars, but they just won't be of a high quality. Certainly, they won't be competitive in terms of the quality to foreign cars, assuming foreign cars don't operate in the same model.
You don't have to theorize about anything. Remember the Beatles' famous song "Back in the USSR"?
Yeah.
Go back to the USSR. Okay. Did they have cars?
I'm not arguing for socialism, Professor, but I just want to bring this point to your attention. I'd like you to address this. Now, in the Scandinavian states, Finland, Sweden, and so forth, those countries have been rated consistently as the happiest nations in the world by, happiness index published by various publications, for a variety of reasons, high living standards, high GDP per capita, and so on. And they have some of the highest tax rates on a corporate and individual level of any OECD nation. How can you explain this paradigm? This dichotomy?
It's very easy. They're open economies. They're welfare states, but they're open economies, and they have big exporting sectors. They're big traders. They have very competitive enterprises in general. And the reason why is that, in fact, they might be welfare states, but they believe in the competitiveness and benefits associated with engaging in international trade and having open trade. So you have to drill down a little bit to figure out what's going on in some of these smaller open economies like Sweden and right. Finland, Denmark. So of course, Norway is an exception because they're setting on such a huge amount of oil fuels the thing.
So the notion that these states are socialist states, that's a misconception, you think?
To a large degree, their economies and enterprise sectors are not socialist. They're not owned by the state. They're private and they're engaged in international trade, and that's the engine that fuels the welfare state. These competitive private enterprises that are engaging in free trade.
Right. All right, I want to come back to combating inflation, and then I want to finish with the gold price.
Plus the fact there are demographic things. All these countries are rather coherent in terms of they're not into the diversity thing. Let's put it that way.
All right, I want to.
If you go to Sweden, you see Swedes.
I would love to visit. My only perception of Sweden so far is based on my visits to IKEA, which in no way is comprehensive enough. But I think you're right on a number of fronts here.
Well, IKEA is a very good example, by the way, of a competitive, innovative, free enterprise system that is totally engaged in international trade. IKEA is all over the place. I mean, the things in China and every place else. And they have a number of other enterprises in Sweden that have had the same model really as IKEA.
Just one final point, I'll move on. Their system of economy, it won't work for a larger economy like the U.S., or will it?
No.
All right. We can revisit that in more detail another time. Let's talk about the quantity theory of money, and then I want to wrap up and talk about your gold price forecast and the Hanke Gold Sentiment Index. There's an update with that you want to share, but I did promise the audience we come back to this. So MV equals PY. How does that work? Can you just briefly explain in layman terms? You wrote to me a while ago that the quantity theory of money, you believe that changes in price correspond to changes in the money supply, monetary supply. Can you briefly, just in layman terms, explain this relationship?
Okay, so we have M and V on the left-hand side of the identity. M is the money growth in the money supply.
Yeah.
And V is a change in the velocity of money, or how fast income is turning over every year. So that's one side of the identity. The other side is P, that's just the price level, and Y is real economic activity. Now let's use the identity to solve a little everybody get their piece of paper out. They can write this down.
Yeah.
So we're going to solve that for M. That is M, the amount of money required to be produced, the growth in the money supply, the growth rate in the money supply that would be consistent with the Fed hitting its inflation target at 2%. So let's fill in the blanks. M is going to be on the left-hand side of the identity. Now move V over to the right-hand side of the identity, and you have to change the sign. So it's minus V. So it was a plus V when it was on the left. You move it over to the right, it's minus V. And what do we have? We have P is 2%. That's the inflation target. That's on the right-hand side. 2%, write down 2%, okay? Now, what's the real growth potential in the United States? Roughly, it's about 2%. It's like 2.2, but just write 2 down, David. And then the last thing is minus V, but V is actually declining at a steady rate of 1.8%. Let's call it 2%. So you have a minus times a minus 2%. Mm-hmm. So that's a minus and a minus is a plus. So you have 2 plus 2 plus 2. That's 6%. That equals the golden growth rate, the amount of increase or rate of change in the money supply that should accommodate and be consistent with a 2% inflation target. So that's where the Fed should be going. If you ask the question, what should they be doing? They should be trying to hit that 6%, 2 plus 2 plus 2. MV equals PY, solving for M. And what are they doing right now? The last 3 months, the growth rate in the money supply has been about 0. And that's why John Greenwood and I think that if this continues for another month or two, we will have a recession starting late this year or early next year. Yeah. Because the money supply is not growing right now.
Okay.
They've already slowed the money supply growth rate down to 0 right now.
Okay. One of the things people are confused with, Professor, maybe you can explain this, is the money velocity has never recovered to the pre-pandemic levels. It's come down to historic lows ever since the 60s. I'm looking at the St. Louis Fed data. It goes back all the way to 1960. This is at a historic low. Now, the money velocity can be briefly explained as the propensity to spend by a consumer. And so if your propensity to spend is so low, one would be confused at why inflation has been so high over the last couple of years, especially now. Now that money velocity is still low, hasn't recovered, but yet we still have high double-digit or high single-digit inflation in the U.S. Why is that?
Well, okay. First of all, there's so much confusion about the velocity, okay. and particularly by everyone who doesn't like monetarism or the quantitative theory of money, they go after V. They say, oh, V is not a constant. And if V isn't a constant, then MV equals PY doesn't work. Well, let me ask this question. Why, let's go back to the start of the show, David. Yeah. Why did Greenwood and I get it right? Why did we predict exactly where the inflation is by using MV equals PY? Because we know what we're doing, for one thing. Everyone talking about this, looking at the St. Louis Fed data, they don't know how to even interpret the data. If we look at velocity in the United States and around the world, Greenwood and I are doing a big study on this, by the way, right now. The rate of decline in velocity is very stable in all countries. And the rate is about minus 1% to minus 3%. I said in the US, it's about minus 1.8% per year. And when you have a deviation from that, as we did when COVID started, you have a reversion back to the trend. And what did Greenwood and I do when we made our forecast? We assumed, yes, we knew the velocity had dropped tremendously, and we knew that it would revert back to the trend, which it always does. And there's an art and a craft in using these things. The art was we assumed that it would converge in 2024. So we made all of our calculations start back in 2021 when we did that forecast. We assumed that we would revert back, the velocity would revert back to the trend rate of declining at 1.8% per year, and then it would start declining on that trend again. So in fact, what happened is the reversion, you had an uptick in velocity. You actually had it, first it collapsed, and then it starts going up. So instead of declining in its normal way at 1.8% per year, it actually was going up a little bit. So you actually goose the money supply a little bit. That is all in our calculation, by the way, of MV equals PY. That's why it's a little more complicated than the 2 + 2 + 2 thing that I just gave you.
A lot of people forget that you were actually in Ronald Reagan's Council of Economic Advisors back in the 80s. Now, back then, Reaganomics was front and center. You actually were part of the circle that spearheaded that group of thinking. You were a supply sider, if you may call yourself that. One of the tenets of supply side economics is to control inflation through taxation. Do you agree then that lower taxes could in fact help bring down inflation?
Well, no, I am a supply sider, and supply side really is a fairly simple thing. It's just basic economics, and that is there are incentive effects associated with changing prices or changing taxes. And if you reduce taxes, for example, you're going to get more of a supply of whatever the tax is being reduced on. So if you reduce the argument is that if you reduce taxes, you will increase the supply and growth potential in the economy, and that will tend to tamp down and control inflation. Now, it will increase the supply and stimulate the economy through the incentive effects, positive incentive effects associated with the supply side reductions. There's no question about that. Yes. It will not control inflation. Inflation is always and everywhere a monetary phenomenon. It's determined by what central banks are doing with the money supply. Okay. So those are two separate things. A lot of people get them confused. Good monetary policy, hitting the golden growth rate, for example, of about 6% in the United States is good. Reducing taxes and getting good supply side Reaganomics injected in the economy is good. In other words, these greed taxes are bad. Or if you look at what they're proposing, the Biden administration, they want to increase taxes. They say that's going to help control inflation. Now, how they get that warped logic into the picture, I have no idea whatsoever.
I guess if you have higher taxes, I'm just guessing here, if you have higher taxes, discretionary spending goes down, and so you get less demand on things and prices go down, right?
Well, this is an old Keynesian fiscalist view of the world. Inflation will be determined by whatever happens to the money supply. Okay. So again, you can't get those things mixed up. It will slow the economy down, but that's the Y in the MV equals PY thing. It'll slow Y down.
There is this school. Yeah, sorry.
And if you look at that in simple terms, it will actually create more inflation because nominal GDP has two components. One is the real economic activity, and the residual is inflation. So if for example, nominal GDP is increasing by 6% a year, and we start with 2% real growth, but somehow we increase taxes and that real growth goes down to 1%, you're going to get 1% more inflation than you had before.
Okay.
So it's inflationary. It's not deflationary. It's inflationary.
Well, yeah, that does make sense actually in theory. So a few more points, and we'll wrap up, and we'll finish with the gold sentiment index now. So there is a school of thought that it isn't a binary outcome here. We know that the Federal Reserve is raising interest rates. Some people say that's causing a recession, and so it's either a hard landing by raising interest rates, or we get inflation. Let's suppose we don't raise interest rates at all. Inflation just continues to run hot. Those are the two binary outcomes. However, if you reduce taxes, you could get a soft landing. I think that's the third option here. So what's most likely going to happen here?
It's really hard to tell what the Fed is going to do, because and the reason it's unpredictable is that they're flying blind. They're not looking at the money supply. They don't look at the money supply, and the money supply hasn't been growing for 3 months, and they want to tighten the screws on things. Mm-hmm. So it's a little bit of a mystery. In the Greenwood and I, in our analysis, to get the 6 to 7% inflation, we assume that the money supply, given what the Fed's doing, will remain at about zero growth for the next 12 months. And then it will come up to about 5 or 6%, which is roughly the golden growth rate. If that happens, then we get the number 6%, 7% inflation.
I see. Okay. Finally, price and wage controls. Is this an option? I'm just going to read a tweet from Senator Elizabeth Warren. Now, a lot of Democrats share her view on price gouging. I'm just going to read this quote here. She tweeted, and she said that the prices Americans are paying for groceries and other essentials are at all-time highs. One of the reasons, giant corporations are price gouging and reaping record profits. We need to put a stop to corporate gouging that drives up prices for families. First of all, I know you disagree with the notion that prices are up because companies are price gouging. We know your view is that the money supply has caused inflation. But is she in theory right? I mean, why can't the governments just say, hey guys, stop raising prices? Wouldn't you just stop inflation?
In theory, she's stupid. And in fact, she entered my Hanke's Encyclopedia of Economic Stupidity a long time ago. This is a knee-jerk thing. What did I tell you was going on in Spain? They have a socialist government, and they're imposing greed taxes. She, in fact, is in the Democratic Party, but she's a socialist. She's in the socialist wing of the Democratic Party, and she's proposing a greed tax. Yeah. By the way, the president of the United States is more or less in that same camp.
I'm just saying, in theory, Professor, I'm not saying they're going to do that where we should, but in theory, why can't a state just say, everybody, stop it, stop raising, we're going to institute a law whereby no private enterprise can raise prices above 5% next year. Wouldn't that just stop inflation?
Well, again, back to the Beatles, back to the USSR. That's the way they did things in the USSR. And tell me, they didn't have inflation in the Soviet Union? It's ridiculous. These things never work. If you look at all the scholarly literature on price controls, they simply don't work. It's a ridiculous, as you say, theoretical exercise. You can go through the exercise and you can argue anything in theory. The question is, what happens in reality, David? This program's supposed to be about reality, not about theory.
All right. Well, okay. Well, theory or reality, either way, you have been correct in calling for 6 to 9% inflation. So congratulations on that, and thank you for sharing your thoughts. We're going to wrap up now with your gold sentiment index. Gold, long viewed as an inflation hedge, and you have actually used the word inflation among other terms as part of the algorithm that shows whether or not gold is bearish or bullish. Your most recent score, I believe, is, well, I'll let you comment on the most recent score and the sentiment on your index here.
Okay, so the Hanke Kaufman's gold sentiment, which I think you're going to put up the
yeah, we're going to have the link in the description as always.
Yeah, so people know how to engage with us and get the score. So every hour, we're analyzing the articles that come out on gold and concluding whether they're bullish or bearish. And so this is very fine-tuned every hour, this way, that way, this way, that way, this way, that way. And what we're finding now, it's very clear to us that when the market, the gold market, thinks that the Fed, when they expect the Fed to stop increasing interest rates, the Fed funds rate, the gold market will take off to the upside, but not before. So the key thing is, when will the Fed stop increasing interest rates? When the gold market thinks that time has arrived, our indicators on the Hanke gold sentiment suggest that the gold market will strengthen.
Okay, it will strengthen. All right. Do you think that gold is right now under pressure from the strong U.S. dollar? Is that why it's not strengthening further?
Well, obviously the strong U.S. dollar always is a thing that puts the gold under pressure, and increasing interest rates puts gold under pressure.
Right.
So those are two factors, objective factors, that are in the mix right now. But remember, we're measuring sentiment. We're not into the fundamentals of the dollar's effect on gold or the interest rates directly. But we can see, we're detecting clearly this business with the increased Fed funds rate and the expectations that they will stop. When those expectations come into the market will get stronger.
Okay. All right. Well, people can access the Gold Sentiment Report in the link down below. I have it on the screen here. And Professor Hanke, before I let you go, what can people access if they do go on this report and sign up? What information do they get?
There are two possibilities. One is you can obtain a free daily score by signing up, or you can receive a much more comprehensive and I think much more valuable set of data at $15 a month.
All right, excellent. Well, that's the price of a Netflix subscription. So your choice, guys. Get a sentiment gauge for gold or Netflix subscription, or both. I mean, maybe you can have both.
The couch potatoes can sign up for the Hanke Coffness at $15 a month and trade gold rather than watching Netflix, and in the process make a lot of money.
Yeah, well, recession's coming up maybe, so maybe this is more valuable than watching movies. But in any case, thank you for providing the service, either free of charge or for $15 a month. And we look forward to having you back next time to talk about your macro views. Thank you, Professor.
Thank you, David. Have a good day.
You too, and thank you for watching Kitco News. I'm David Lin. Subscribe to our channel for more.